Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Louis Navellier, chairman and founder of Navellier Associates, to discuss energy prices, GDP growth, earnings, and Fed projections for 2024. It's great to see you as always, Louis. Happy New Year and welcome back to Trade Talks.
It's good to be here.
All right, you got it. Let's start with energy prices. You think that they could increase for 2024. What's the thesis behind that?
Well, seasonal demand usually picks up around mid-February. And so we're going to get that normal spring surge, for lack of a better word. The other thing that's going on is there's still a risk that Russia's production could be disrupted. We just learned that there were 6 tankers headed to India. They couldn't dock because of new sanctions. Could have been some insurance factors. So those boats have all left and could not unload in India, which was going to refine the oil. The other thing is you got to realize Russia's had their natural gas pipelines blown up. They had their Trans-Siberian Railroad attacked twice in 2 different places to disrupt their trade to China. And we assume it's by Ukrainian operatives. And the question is, will Ukraine go for their crude oil pipeline? If that pipeline in the Arctic breaks, it's a disaster, not only environmental disaster, but it'll freeze and it'll really disrupt production for a long time. And as you may know, Ukraine and Russia are still going at it, and it's very tragic.
So where does oil go from here?
Well, I mean, if we have a disruption with Russia, like the pipeline, we're at $100 a barrel. Otherwise, it's just based on economic growth, and we'll probably be at $80 a barrel in the spring.
Mm-hmm. And you believe GDP growth will exceed the Fed's projections, and AI could be an impact towards that. How could AI impact GDP?
Well, AI is a productivity enhancement, and as productivity goes up, GDP goes up. And so I'm very comfortable and confident that we'll continue to get more productive as a society thanks to AI. I mean, retail is probably the best example. I mean, everybody orders online now, and the companies that have a good online presence and get a lot of orders do better than the ones that have storefronts.
And of course, the key question is, what does the Fed do this year? Where do you think that the rates go for 2024?
Well, obviously, the dot plot said 6 to 7 rate cuts for the next 2 years. They're anticipating 3 this year. I think they have to do more because they're over 100 basis points below, above market rates. And so they're going to have to cut to get in line with market rates. And also, we have a lot of deflationary forces underway. We saw it in the PCE for November. China's had deflation for 2 months. Germany had deflation for 1 month. So it's when it turns to deflation, I think we have to cut pretty fast.
Yeah, well, it sounds like so we have GDP improving, we have, rates coming down. I believe your target rate was 3%. How will this impact earnings? Do you think we'll continue to see the momentum?
Sure. The year-over-year comparisons are very good for the next 3 quarters. So we're gonna have lots of earnings growth, even if the economy only grows at 2 or 3%. So I'm very comfortable and confident this earnings announcement season. Also pretty happy with what the analysts revisions have been headed into the season. Of course, the analysts have been on holiday and they're going to come back and revise some more. But we're going to have a stunning earnings season for the next 3 quarters. And then it's a presidential election year. So we typically will rally right up to the election.
Let's talk about stocks in general here. One of the key themes for 2023 was a concentration in a handful of names really driving the indexes. Do you think that we'll start to see breadth spread a bit for 2024?
Oh, we definitely have. It's broadened out quite a bit. In May we had 20 stocks leading the S&P up from 8 in April, and then we had a small cap rally in June during the annual Russell realignment, and then of course the small caps really took off October, December, and we had an early January effect. So we're expecting a very strong January effect and the small caps to catch up. I do both large and small cap, and literally I have to pay 3 times the P ratio for large cap and small cap. Small cap's really cheap now. So I'm very comfortable with them. The final comment I'd have is, it's, how do I say in a nice way, it's time just to just pile in. I really like how we went up on light volume. If we get any kind of real volume underneath this market, we're going to go up a lot more.
All right, we'll leave it at that. Louis, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks.